Hello, everyone, and welcome to the Property Trio, the podcast for the sophisticated property buyer. And we are probably lacking sophistication right now if you read any of the budget papers. We obviously did a bit of a special in place of the market update last time. Of course, now we do need to zero back on the month that was April. And of course, we will continue the chatter of what this likely means for property post-budget, if this all gets legislated. And to unpack everything, as always, Cate Bakos and Dave Johnston. Good morning.
Good morning.
Morning.
Lots to
Where do we
unpack,
start?
of course. Yeah, I know. Where do we start? Well, we won't talk about the budget because we did do a full episode. If you missed that, go back and have a listen to that. But let's have a look firstly at the April results, which are in a beautiful, unencumbered, budget-free environment. However, in a war in Iran environment, in a post increase in interest rates, although there is a bit of a data lag there to some degree, but already a few standouts. Sydney and Melbourne backtracking. Do we want to talk about that first of all?
Hefty backtrack. 0.6 in 1 month. It's a tough backtrack. If we got 0.6 of growth in 1 month, we'd be getting pretty excited. In fact, I think that was the extent of our strongest month's worth of growth in Melbourne over the last 2 years. So, yeah, it's not a great month for Sydney and Melbourne, but I'm looking at Brisbane at 1.2 and Perth at 2.1 and Adelaide at 1.1, Darwin at 1.3. Like, what is going on? And what I will be really interested to see is what happens with those states and capital cities next month.
Yeah, I think some of those will be exposed, right?
I do, yes. Namely, Perth and Darwin.
Dave, we did an episode on mean reversion, which was, the pet kind of project of property forecasters to say Melbourne has been so much in the doldrums that it's its turn. It has to come back. And we're now printing an annualized growth rate of 2%, the lowest of any capital in the country. Have we put that one to bed?
Look, I think cycles can play out over a long period of time. I wouldn't put it to bed just yet. I think one thing that mean reversion often happens but doesn't always happen, like most things in life. So it's probable but not guaranteed, So just
my clickbait headline, Dave, you've ruined that.
Yeah. Probable but doesn't always happen. I understand exactly what you're saying, Dave. I think you need a longer range than 6 years. That's what I think.
Yeah. So, it's very interesting. Look, one thing that's become clearer and clearer on my travels around this country, and we did caravan around the country for 9 weeks last year and then have been interstate various times, is Melbourne and Victoria absolutely on the nose. And, it's gotten the point, you're chatting with someone from another state and you say you live in Melbourne, and the first thing they say is something condescending about Melbourne, or they feel sorry for you, or what's going on down there. And, I think that is part of what's playing out in it. It's being reflected in our property prices. We've touched on some of the reasons why Melbourne and Victoria are on the nose, and, it certainly harks back to the excessive lockdowns through COVID, and then goes on to high taxing and land tax and, probably, high crime rates. But, it's got a really bad reputation. That's the reality of where we're at now. And, it's sad to say, but you see Melbourne on the all dwellings list, it's 6th in terms of the highest median value now, down at 822,000. And even with houses, it's 6th now at 972,000, behind Sydney, Brisbane, Perth, Canberra and Adelaide cracked 1 million recently. So, Yeah. Now, look, there's always markets within markets, which we talk about, and certainly there's that big story continuing to play out of the bottom quartile outperforming the upper quartiles significantly, and that's that's part of why Melbourne and Sydney, with the largest percentage of top end price properties, their medians aren't growing at the same rate and are finding it tougher during these times. But, Sydney is well ahead of Melbourne, even though they are both, negative at the moment.
Kate,
Yeah,
we
that
had a
ratio is
webinar.
wide.
Yeah, it's huge, right? And when we talk, you raise a very sensible point, and we can always count on you for being sensible, Dave. Myself, not so much. But of course, we don't expect this trajectory to change. We don't expect Hobart to overtake median dwelling values in Melbourne. But gosh, it's heading that way at a rate of knots. Kate, we did a webinar where we were talking to all of the PIPA members, and one of the slides was about, well, what do we expect to happen to the market? And again, Dave makes a great point. There is no the market. There's all sorts of different markets. One of the things that we said is that the top quartile could possibly be quite resilient as one of the last CGT-free bastions in assets in Australia. And the lower quartile, which has been the performer, could see some lumpiness, especially in areas where it's been dominated by investor purchases. How do you see that playing out?
Me? Yeah, well, we did chat about that. I think that the fuel that we've seen in those really rumbling markets over the last 2 years have been investors, particularly interstate investors en masse. I know of firms that are buying many properties in a particular area in a given month, and there's a bit of a pattern. The pattern has been the lowest priced established house areas. They've tended to be fringe and lower socioeconomic areas, and those markets have absolutely taken off. We've got some of the larger regions, we've got fringe areas in capital cities, and I'm very fearful that given the intensity of investor demand there, when we see investors switch out of that, which they will, there's no doubt in my mind, unless the proposed legislative changes are massaged and adapted to something different, I think that we can anticipate at least 9 out of 10 investors who would have targeted those markets will be out of there. They won't be investing there. Now, the question will be, what happens to the investors who have already bought there? Will they stay there, stay put, enjoy their negative gearing benefits and keep their rental properties in those locations? Could we see investors get the jitters? What we do know, though, is that force field of investors that have kept prices rising will drop out of those markets immediately. Now, the point that you made about the family home is a really important one. And, Dave is a perfect case in point of a sophisticated investor who's made a decision, aside from his business investment, obviously, to invest his wealth in his family home. And I think that will
Not all of it, but certainly a reasonable chunk. That's like your property acquisition was very well considered, and you have a gorgeous home that's well above median in a great area. I think that will serve you well, because going forward, provided the tax environment doesn't change on PPOR, you've got a property that you'll be able to sell and not have any CGT capital gains tax to pay, and then your retirement plan will absolutely benefit from the sale of your family home and whatever your next move is and all those years in front of you. So you've had delayed gratification in that decision that you've made, because you're not getting any cash flow out of having this awesome home. You're just getting an awesome home rather than having a smaller property and then a bunch of investment properties. But I think a lot of people will pivot to that kind of strategy. And I think that the established markets, and particularly the inner ring and middle ring where incomes are higher, we're going to see people sitting on their houses for longer, buying the best house that they can, improving the property that they're in. And I think stock on market, once we've had this exodus of older,
investors selling down over the next 13 months, I don't think we'll see very much movement in that established house market in those good, inner ring and middle ring suburbs. That's my fear.
Yeah, I think that's certainly they're likely to be held on to much even more tightly than they already were. I hope I don't have to sell my family home. That's the long-term plan, is not to sell it. So, but I can understand, and I've got obviously my business and other investment interests, but I can understand, why people will move even more so towards, investing into the family home, which has no tax payable on it. But I've talked about this for a long time as being underestimated and undervalued as part of the overall investment picture because of that huge benefit of having no CGT payable upon the sale, and certainly providing that option for people to downsize. And then there's also the ability to put big chunks into super if you do downsize as well for people. So I think it's further incentivized property to be owned in self-managed super funds because of the low taxing environment there. So I think we're going to see a bigger shift into properties in self-managed super funds as well.
Yeah, Dave, I hope you don't mind me using you as a case study without asking.
No,
what
I don't mind.
Meant,
you
though,
were just implying. I
know it's not your only investment.
That was my strategy. As I thought.
Well, I think it's very wise that you talk a lot about people getting the family home right first up, or having that as a priority, rather than collecting investments and then saying, oh, geez, let's think about our home. You've always been very clear that a family home is a big part of many of your strategies for your clients.
Well, it's the main part of most people's strategies in Australia. So that's why I focus on it. And I get buyers advocacy businesses have a vested interest at the end of the day to particularly focus often on, and some of them only solely focus on, investment strategies. But the reality is most Australians retire owning one property, and generally that property is a home. 2/3 of all properties in the country are owner-occupiers. Most people prioritise purchasing a family home. And what I see too often, because that is the vast majority of what people end up prioritising and retiring with, is they start off with this investment strategy that they don't have a long-term view on. It ends up falling by the wayside, being sold, and the family home ends up being prioritised. And so that's why I talk about it a lot, because it does usually end up being the only asset people hold, or most people only have two or three. It usually is the most expensive, but it can get in the way of your investment, other rentals that you've purchased along the way, and that's what I see often. So that's why I talk about it so much, because it is what most people end up prioritising.
Yeah.
I think he's mid-reno, and you talked about selling it, Kate, and he was triggered by that
as
well. He hasn't even had a chance to enjoy it yet.
So true.
Hopefully I don't ever have to sell it, but who knows? It does provide extra options, that's for sure.
At least wait until after the property trio dinner party that we've been talking about.
That's it.
Now, Kate, you were talking about the rumblers, the outperformers. So for the month of April, Perth 2.1, absolutely bananas, and Brisbane 1.2. We've got 1.3 from Darwin, 1.1 from Adelaide. The rest are parity or a little bit backwards. But the real story for me is in the annual and the 10-year. So if we look at Perth, 26% annualised growth. And then we've got Brisbane at 19.7 and Darwin 19.6. Those are enormous numbers.
Huge. I remember when Victoria did that. Oh, my God, Melbourne's going crazy. Yes, they're big numbers. The one that struck me was actually combined regions. So the combined capitals did 0.2%. Clearly, Sydney and Melbourne dragged that down. Combined regions did 0.9%. This is for 1 month. That's significant for the combined regions. Unfortunately, I don't think we're going to continue saying that because there is a lot of investor activity driving that. And again, it will be segmented. I'm always sad that we can't segment regions. I love looking a bit deeper and saying there are different price points, the different states, the different bigger regions that are really humming. But I think we can expect to see that change quickly.
I've actually got a little bit of segmentation on the regions. So the focusing on SA4 submarkets over the first 4 months of the year, the strongest conditions were WA's Bunbury with 9.8% growth in just 4 months, and Queensland's Darling Downs, Maranoa, 7.9%. And then the far west of New South Wales, so is that an Orana, 7.5%. So they were the largest growth over the last 4 months in the regions. One thing, even though 0.9 is quite high, certainly relative to the capital cities, it actually surprisingly, regions have been so consistent, but that 0.9 is the smallest rise in the regions in 9 months.
I suppose that makes sense when we sort of transpose the interest rate environment and some of the sentiment things, which of course are declining, and we'll look at that a little bit later. But still resilient, right?
Yeah, 100%. Very resilient. I've got to admit, much more resilient than I've expected it to be over the last few years. So, yeah, it's a story.
Now, investors traditionally have invested for the long term. It's really only been, I think, since Perth kicked off that I've been hearing a lot more talk about short-term strategies and even paying that 50% CGT discount figure to go into those markets. I wonder if those strategies will be impacted by indexation. But really, we should be taking most of the time a long-term view. And if we look at performance over the past 10 years, we've got a couple that on an annualized basis are, doing 10% a year, which is bananas. We've got Perth at 107, Adelaide 111, and Brisbane pretty much 120%. Contrast that to other markets that are performing really strongly at the moment, like Darwin, only 27.2% over the past 10 years, even though we're about 20% growth in the last 12 months. And of course, the sad story we always come back to is Melbourne, which is not as bad as Darwin, but 36.9% over the past 10 and 5.8% over the past 5 years. So that really brings it into a sharp focus, how that's been doing in the last little while.
I think you just made a really good key point there, Mike, and that is comparing Melbourne to Darwin, because Darwin's been, a pin-up child for the last year, and this just demonstrates cycles really, really well.
Yeah, I mean, 100%. You look at what also demonstrates the cycle of Darwin, because it did go backwards for a lot of the last 10 years. The past 5 years have been 33% growth. The past 10 years has only been 27%, highlighting negative growth during that period of 10 years as well.
And it's been a bad 5 years and 10 years for the blue chippers of the world. Combined capitals doing 33.7% over 5 years and just under 70% for 10 years, whereas the regionals just over 50% in 5 years and over 100% in 10 years. So that's what we were talking about. You can
thank COVID for that. You can absolutely thank COVID.
I think, COVID definitely kicked it off in the sort of beginning of the last 5 year period, but there still remains a degree of affordability and flexible work that I think factors into that as well.
Yes, most definitely. And, that carry on from lockdowns of working from home, and now, we're saying it in Parliament. I think that's definitely a hangover from COVID that's here to stay for a lot of sectors.
Yeah, I think definitely that work from home factor is continuing to play out in our property markets, where it's getting more decentralised. You're more able and not needing to work from major capital cities, and people are making decisions and choosing to live and operate in smaller, mid-sized capital cities or major regional centres. And yeah, that's definitely part of what's happening.
Now, I promised we wouldn't talk over and over about budget, but it's kind of hard not to, right?
Yeah.
And one of the things that we are looking at very, very closely, and it'll take a little bit of time before we see the data, will be rents. Treasury predicted a $2 a week increase on the median rental price with these sweeping changes. I don't know if I'm allowed to say the word bollocks on this show, but I have.
Yeah.
I can't imagine that's
Yeah, I want to
true.
see that spreadsheet. Oh, someone's missed a key assumption there.
Zero, I think, potentially.
Yeah.
But let's have a look at rents. What are they doing at the moment? It sort of seems like they've come, off the bottom pretty hard. We had some rapid growth in the last little while. The pace of acceleration seems to have moderated, but we are still in an environment that is atypical if you zoom out for 30 years. Rents typically, before we saw them go through the roof, would underperform inflation. That hasn't happened really since 2001, perhaps.
Yeah.
Yeah. I mean, so, yeah, there's no evidence that the rental market is starting to loosen. Vacancy rates are holding really, really low, and rents are just continuing to rise. They're 5.7% higher over the year, and that's the fastest annual pace of growth since October 2024. So that's 18 months ago, and rents have been rising rapidly for a long period of time. So that's adding approximately $38 a week to the national median rent. $40 a week is a fair bit to a lot of renters, and so I feel like this is where the big story is going to lie post the budget and post if the legislation goes through as they've stated they want, with regards to what they want to change with capital gains tax and negative gearing and all the unintended consequences of that. I think watch this space with rental rises.
I couldn't agree more. I look at the pace of increase over the last year or so. I put that down to rising interest rates and rising compliance costs and just, more limits on the control of an asset that an investor has. And if we overlay that with these new changes, I don't think that anyone in government looking at their spreadsheet I don't think that they can imagine what this chart could start to look like and what the impact of the budget decisions will have and will be for investors.
Well, let's just say that we're correct. It's our show. We can say whatever we want. And this does actually exacerbate the problem. This is a rather large component of the CPI basket of goods, rent. And I'm sure that the Labor Party currently has a bit of a thorn in the side with the inflation we have at the moment. Governor Bullock has all but said they need to stop spending money because it's making my bloody job hard. Of course, she's far more political and professional than that. She keeps off to the side. But this could be a huge problem for inflation if rents continue the pace, especially if it gets worse, which is our expectation from this budget announcement. Dave, how do you see the stickiness of inflation when it comes to maybe the fuel excise coming off, the rental increase? We've got quite a few headwinds to getting that back down, right?
Yeah, I think it's a serious concern. I think it's almost as concerning as any period I can remember, to be honest. Inflation rising, the uncertainty of the Iran war, the interest rates having to go higher to slow down inflation, and rents are rising rapidly. And then we put these policies in place that the government have proposed that I think are only going to exacerbate these issues. And so there's a lot of incentives. I do think there'll be people who sell between now and 1st of July 2027. So there'll be a few more properties on the market. Some people will do that to not have to potentially pay under the different capital gains tax regime after that. But I think established properties are going to be, all the people with their grandfathered benefits are going to hold on to them. Anyone who's buying established properties from an investment perspective have an absolute vested interest to hold on to them, to soak up their losses, which could take 10 years, 15 years, 20 years. So I think you're going to have more people, obviously first home buyers are even more incentivized to buy. So you're going to have less rental property. Rents are going to be going up. I reckon we're going to have rates going up. I think we're going to have high inflation, and you're probably going to have high interest, and you're probably going to have some property prices flattening for a period of time. So like the next 6 to 12 months might be the best time to buy ever. And you are going to have almost everyone unhappy. I think it is a big possibility, and that's going to be playing out over the next 12 months.
Cate, typically when we look at yields across the capital cities, Sydney and Melbourne at higher price points tend to be quite low. Interestingly, we've got Melbourne in third place for yields. When was the last time you saw that?
I haven't. Ever. I mean that. I've been an investor for 30 years this year. Haven't seen Melbourne in third place ever.
So we're talking 3.8% behind only Darwin at 6%, which is bananas, and a very different peaky and trophy market. Canberra at 4%. And, well, actually, I tell a lie, it's in fourth place.
Yeah, we're number 4.
Hobart
but that's,
in the mix as well.
I still haven't seen that, Mike. It's quite remarkable. You know, I was just doing a little calculation on the side there when we were chatting about the budget suggestion that we'll see a rental increase of roughly $2 per week. So I just looked up what's our national median for rents. It's $675 a week. So $2 there represents a 0.3% increase. Are they delusional or what? Like, we're seeing that monthly, probably even, fortnightly in some markets. To suggest that that's the annual increase, I think it's delusional.
Well, I don't know if they're saying it's annual increase. I think it's how much extra it'll increase on top of whatever the changes are in rent already, or whatever the market would have already been doing. It's still minuscule.
Ridiculous
I think
suggestion.
It's ridiculous.
Yeah, we just know that.
Well, I mean, like if we look at the vacancy rate, this might cause more new properties to be built, but they're not going to come online for 2, 3, 4 years. I think, unfortunately for them, we're going to see some really negative outcomes for a lot of the Australian
investors and first-time buyers.
And existing homeowners too, if property prices are quite flat or falling and people's, main source of wealth, their main asset value is struggling to increase or go backwards, they're not going to be happy. And that's a big percentage of the population. Let's face it, once you buy your first home, you jump into that segment of the population who wants their property to be going up as well. Yeah. And, we've already got the lowest vacancy rates on record. And I think people are going to hold established property even more tightly. And I think the average over the last decade, because of the impost of stamp duty and moving, people are holding their properties on average for, I think it's something like about 2.5 years longer than they used to. I think that's only going to increase. And then, vacancy rates for the previous decade's average was 2.5%. The decade before that was 3.3%. We're now down at 1.8%. Rents are going to keep going up. And, there's not going to be many people happy with what's happening in the economy. And I think we're just at the early stages of this, because some of these factors are already at play. Rates going up, the, high inflation, pretty poor productivity. And this is just going to this is going to just pour some more petrol on the fire. What do you two think?
Well, even petrol's expensive, Dave, so it makes it even worse.
I was down last week for a reason. This is a budget that's a mess, and the threat to productivity, the threat to falling house prices, the threat to crazy rents, the threat to increasing inflation, with rents being, one of the significant drivers of that, and the implication of inflation that we can't get under control, it's not looking good.
And you can add to that, entrepreneurialism, aspiration, just...
we haven't even talked on that, have we? Like the capital gains tax impost on, business owners and
business.
There was
We're
a
going to
great
see a lot of
article.
startups going over the ditch.
And there's less incentive.
The economy's in the toilet. They need all the help they can get, and maybe the next Canva will be founded in New Zealand rather than Australia.
Yeah.
Yeah.
I think.
Do you want to unpack that a little bit about the fact that capital gains tax is applicable across all the higher capital CGT across all assets?
Yeah, because I think that has an implication for our international competitiveness, and we rely on international investment. Sure, we make coal, if that's a thing we can make. We don't really make anything that dinosaurs didn't sort of put down for us. So we do rely on international investment. And I spoke to someone last week who basically said, changing the rules is one thing, and then going about your business from then on after. But changing the rules retrospectively is a very problematic way to signal to the international environment of how we want to do business. So, look, there's obviously lots of minutiae around what would happen if you're starting business from scratch or you're purchasing a business. But at the end of the day, your risk-adjusted returns have become less attractive. And there's environments like New Zealand, which are CGT exempt. And Australia has now amongst the highest CGT environment in the globe. So, it doesn't.
Not a proud moment.
No. What do you think, Dave, in terms of, obviously you're sort of plugged into the entrepreneurial stuff and prop tech sector and those sorts of things. Have you heard many rumblings around the reaction from startups and founders for CGT changes?
Well, I think people are very unhappy, very worried. I think, thankfully, there's a fair few of them at the higher end who are talking to politicians and have people's ears and trying to influence behind the scenes. And I think there's potential for some sort of carve out in that space. But, who knows? It certainly disincentivizes people just to look to take the risk, go and, put capital down. You may never get it back. You never may earn an income. Most businesses fail in the first 1 to 5 years. There's so much risk that goes into starting a business, and then you're creating new jobs for other people. You're paying taxes along the way, and then there's, you're hoping in many cases you take really low income. You even have people coming to work with you on low incomes with the idea of getting equity in the company or the business you're working in. And then the payout, you hope, for a lot of businesses, is potentially selling or reducing your equity down the track for any kind of business. And what you're going to receive down the track is so much less under this new CGT regime. So it just disincentivizes a key driver of any economy, which is obviously new businesses starting up, because markets and industries are always evolving and changing, and what worked yesterday won't work in the future, and so old businesses fall by the wayside. New businesses have to take up what is the new way to do things, and so it's a big disincentive to a lot of people.
I don't know if I'm being optimistic here. I've listened to a couple of interviews, and I suspect if we've got any modifications or changes to the proposed new policies, this one might be one that they're having a rethink about, and particularly the differential of outcomes for new startup businesses, particularly low capital businesses like service industries that can start from zero, versus your bigger organisations. I will not be shocked if we see some significant changes, and a way that they can come forward with policies that cater to different types of businesses.
Yeah, I agree. And they've provided some incentives for venture capital to invest in startups and have lower tax regimes. So the other end of that venture capital is new startup businesses. So you think if they're going to support the venture capitalists and their investments, you'd think they'd actually provide a bit of extra support to the people who are actually starting those businesses.
Yes. Yeah.
Tell you who is getting support. Just over $5 million for the CFMEU to help them with their administration challenges.
Stop it. I don't even want to talk about it.
With Victoria.
So angry. What could have we done with that money for a great organisation that creates real value rather than throwing it at them? Anyway, moving forward.
It shows how connected they are behind the scenes.
Sorry, Kate. I thought that would trigger you, but
yeah, thanks.
I know, but it's important. I think it's kind of bundled all together, that the bizarre priorities that they have and what they're promoting and what they're stifling. It just seems very out of touch. Let's go to
when I think of our Premier, I imagine like a kid who has their index fingers in their ears and they're walking around saying la 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 la. That's how I imagine our Premier.
Anyone that's a graphic design buff, chuck that in the comments of one of our Facebook posts. We'd love to see that.
I'd love to see it.
Let's move along so we're not triggering too much PTSD for you. Listings. We saw a little hockey stick in April. What's going on?
Okay. So new listings. Let's chat about them. Less than 30 days old. Massive decrease in Sydney. The monthly change is negative 22%. Melbourne, negative 13. They're the big ones, along with Canberra, negative 13. What does that mean? Well, with less listings, you'd like to think that your supply-demand imbalance starts to sort itself out. They're the markets that have been delivering not so great results, particularly Sydney and Melbourne. So that'll be interesting to see it play out. But to be completely honest, Mike, I don't know that we can look at these charts and take much out of them in light of what's been delivered at budget night. I think the exciting new listings conversation is actually going to be this time next month. But what we can see on the totality chart.
One reason for that is because of a lot of public holidays during that period.
Yeah, it's a really good take, Dave. It's a great observation, although we did. We had Easter and then we had Anzac Day. Yeah, good pickup. Because if we look at the new listings on the totality chart, you can see, as Mike said, a little hockey stick. It's poking above the 5-year average, but we've had lower volumes typically during May, June, July, August nationally because of winter. I think Easter might have had a little bit to do with May looking a little bit stronger. We've sort of pushed all of our listings, into this later segment of the market. But I think longer term, it'll be interesting to segment whether they're investor-led or whether they're owner-occupier-led, because I think that we're going to see a dramatic change.
You raise a good point. It was trending up towards the 5-year average at a rate of knots, but who knows? I mean, the data is now, let's just say, it's embargoed until we actually see the results of what's happened with the budget.
And I think I even don't think we'll get a real sense for a few months as to how things are going to play out.
Yeah.
And like you just said, Kate, I think we want to be able to sort of be good to have data on investment property sales versus owner-occupier sales and how that changes.
It's reasonably crude in terms of how seriously we can take the data. And the reason I say that is they can only really track it online based on having a rental history online. And so the properties that aren't included in that are those that have been privately rented, but we all know that they're few and far between, particularly these days with compliance and all of the pressures on landlords to have, a professional property manager. But yeah, they do have insights with the data, and it's at least very helpful to see trends.
Yeah, and look, one thing we do know is that even though the Perth, Brisbane, Adelaide was still performing really strongly, their rate of growth has been slowing already over the last few months, and they're still, obviously, Perth still off the charts. So there was already that trajectory happening with the higher interest rates, the Iran shock, before the budget was handed down. So I think in terms of prices, we're going to see a flattening across the board.
Yeah.
Well, we flagged sentiment earlier, and of course there's pre and post budget, but sentiment was meaningfully changing pre-budget, which I think will inform sentiment post budget as well. Kate, what were the standouts for you? I know the time to buy a dwelling was concerning.
Oh, that's big. So our annual change for time to buy a dwelling is minus 20%. Our monthly change is minus 16.1. So we've just seen this huge swing in the last month. Now, what's really interesting about this is it only recently came out. So no doubt it's taken into account a lot of budget fears because it was the most leaked, most unsurprising budget in some respects. But we also have a lot going on overseas, and we had an interest rate increase, and we've got a lot of talk about inflation not being under control in Australia. So I think, that's just a really nasty cocktail of bad news that's put a lot of pressure on that particular sentiment.
Yet somehow, Dave, we seem to be a little bit optimistic about family finances. What's going on? Does the nation have some sort of bipolar thing?
Well, there's some name for it, how humans get used to their circumstances within about 2 weeks, whatever they may be. You might be in a war zone or something, and, is it your heuristics? But you start to get used to it. So I think that is probably the adapting to what was happening in Iran and, the initial sort of reaction. And then it's like, okay, we're back, to feeling like this is a new normal, and it hasn't seemed to have impacted us so much. But that's
still down for the year, though, right?
That's right, still down for the year. But I've got some, because some of this did happen after the budget, and so I've got some of the detail of so how people responded to the consumer sentiment post the budget. So 15% of consumers are expecting to be better off. 34% are expecting to be worse off. So that is much larger deterioration than the last two budgets. The gap last budget was 10% and the previous one was 3%. But interestingly, over sort of a longer period of time, people do have a pretty big negative expectation on the budget relative to how it's going to impact them. So it's not totally out of the ordinary for that bifurcation.
Begs the question, who is thrilled by the budget? Is what cohort of people? Because I think first home buyers, which was the mark that they were aiming for, I don't really hear any of them saying, like, finally, we've now got our time in the sun.
I actually disagree. I think first home buyers who aren't aspirational in as much as wanting more property are saying, okay, cool, the investors are going to move out of the way for us and property prices might soften. That is the only cohort that's saying, yay, great budget. And those that don't read the news and just, believe the rhetoric. And I think also your established investors who are preserving the negative gearing benefit and aren't so bothered by the capital gains tax changes, because we discussed this on budget night, I think, Mark. The indexation method doesn't necessarily disfavour someone who's held for a very, very long time. They might actually find that they're in front. So it's not all bad news for older owners.
Well, I can tell you how the numbers actually played out across the generations, if you like.
Dave.
So the baby boomers and Gen Xers, unsurprisingly, were 30 to 36% thought they were going to be worse off. Okay. So I don't know if maybe it's 30% for baby boomers, 36% for Gen X, where millennials, the gap was just 9% who thought they were going to be worse off, so much less. And the Gen Z or Zoomers were actually 1% net positive about the budget. So they were probably the ones who were most pleased about those property-related changes.
Yeah, I suppose we've got less than 24 months until the next federal election, so those first home buyers will get a sense of, has it fundamentally made things easier and changed things for them. However, in a high inflation environment, their interest rates are going to be difficult to stick with, and their borrowing capacity will be diminished as well. So I wonder if those two headwinds counteract any perceived, positives from the market slowing down or a lack of competition in their price points. But we'll be here to guide you through it, as always, every month. So stay tuned to that. Let's go to lending.
Just one other thing that was interesting that I found out. Did you know that sentiment generally declines with age? So
okay. It's like everything's gone to the dogs.
That's right. Not as good as it was when we were younger. So it actually moves on average down 1 percentage point every 2 years as you get older.
That's sad. As you wake up out of bed in the morning and something hurts, or you can't touch your toes in the way that you'd wished, it makes sense, right? So if you find a chipper, happy octogenarian, give them a pat on the back and say, good for you for being glass half full, because you're breaking the statistics. Lending. Kate, we were in consultation, I suppose, in the lead up to budget, looking at first home buyers, and first home buyers have been a lot more active than perhaps the media would like to report. How do we contrast lending to first home buyers versus investors, say?
Oh, they're both up, both of them. So investor lending, investors continue to drive lending indicators, with the volume of home lending for investment purposes up 5.5% over the quarter and 23.6% higher over the year. So that's an issue for investors, and we absolutely know that.
Yeah, so it's interesting, I think, with the shock of the Iran war and rates rising, we've certainly seen a drop-off in lending, and we've seen a drop-off in property purchases as a total, or sales, if you like, across the country. So owner-occupier finance has actually fallen by 4.3% and investors by 3%. So, it's going to be really interesting post the budget. I think we'll continue to see investor numbers drop as people sort of digest the new reality. What does it mean for them? More people, which I think will happen, jump into new property, but people start to realise that, if you can hold and you have a good long-term plan supported by a strong mortgage strategy, quality established property is going to become even rarer. And you're still able to claim the losses. You just have to be able to hold the property until you can soak up those losses.
You wrote a great post about that on LinkedIn, I saw. I've 3 times tried to comment and say that, but I've been interrupted. But just so you know, I am in your corner, Dave. That was an interesting take, and I think it sort of gives people a little bit of perspective to understand that these things can be built up and really fundamentally change the back end result. It's just holding on to that asset. That's the real value of getting it now rather than later, right?
Yeah, 100%. So I think, like taking the Mickey or looking at the opposite, I think we did this sort of graphic with AI about pay no tax on your rental income, because once you start becoming cash flow positive, you're actually going to be paying no tax because you're soaking up old losses that you didn't get to claim.
It's
So
the 30 I've ever seen you, Dave, actually.
Yeah. Well, this is big news. So I'm actually trying to get a meaningful post out every day, or just one and one on the weekend. So yeah, please, I would love any of your comments or likes, Mike.
Yeah, and anyone listening, of course, Cate and Dave and myself are fairly active on LinkedIn, and we share lots and bits of pieces that don't always make it to the show. So if you are on LinkedIn, like all the cool nerdy kids are, give us a follow and we'll share some more data. Let's talk about interest rates. Obviously, we flagged that we're in an interest rate rising environment. Where are we at in terms of sort of historically, and what are the markets predicting? The bond rates have been ticking up. The Australian dollar seems to be following, which is good if you want to go overseas, especially to New Zealand, where I think you're getting $1.21.
Or if you have offshore staff as well, it's good.
True.
Yeah, well, the bond chart suggests that we're roughly sitting, where we're likely to be for a while. But the problem that I've got with all of this is any global concerns, any rattles to this cage, we can quickly see sentiment change, and obviously inflation pressures are biting with the things that are outside of our control, and also the things that we wish weren't happening. So I don't think that we can hang our hat on what's average or necessarily what the bond markets are telling us when we've got so much instability and so many shocks.
And I suppose if we look at wage price growth, we have actually been doing all right nationally with wage price growth, but it's at the point now where it's not necessarily keeping up with inflation. A lot of the commentators are saying if you feel poorer today than, say, a couple of years ago, it's because you are. What do you reckon, Dave?
Yeah, I agree. And, productivity is pretty much the only way to increase your standard of living and your income relative to the increases in the cost of living. So, that's where we should be really focusing on policy to drive up productivity. I think there's no doubt AI is going to make big jumps in productivity. And so as a nation, we should be trying to invest in and become leaders and support and back AI implementation with some sort of guardrails. So, but really, productivity is the name of the game if you want your standard of living to increase.
Yes, and that has been a problem in Australia for a number of years. And now the incentive to invest in productivity seems to be yanked away to some degree. So really, there's a lot that we're expecting to see in the data in the next little while. Of course, the budget was the 12th of May. When we look at, say, data from Cotality based on settlements, we probably need to add another 3 months from there to get some real good pictures, although we'll be keeping a good eye on sales volumes, which are a little bit closer to the measure. That's a bumper episode we've had today. Give you both the opportunity if there's any other things that you want to share with the listeners before we close.
I just want to let our listeners know next week we'll do another episode focusing on the budget as it relates to property in particular. So please tune in if you want to keep wrapping your head around what the changes are and how we think they're likely to impact the property market and property buyers moving forward.
And keep your questions coming. We're going to craft next week's budget talk number 2 around a great listener question that we got. So please do send them over. We'll do our best to deep dive and research and share our honest thoughts as well.
Yeah, and we love the questions and the feedback that we get from the shows that we do around those are really positive from those people to help build some clarity. Dave?
Yeah, I was going to say, and I think a number of us were commenting on some of the outcomes on our socials. So whether it's LinkedIn or Facebook via the our companies or the Property Trio. So yeah, jump on there as well if you want to sort of get a deeper understanding of some of our takes.
Well, that was the month that was April, and some data from post-budget as well. Of course, there's a lot more to come in the coming weeks and months, both from data and from us. So please like, comment, subscribe, stay tuned. We'll guide you through these turbulent waters as best we can. Thank you, guys.
Thanks, guys. Good episode.